Who would your favorites be in this group, and to what extent are high home prices helping versus hurting some of these participants?
Hi, Kelly. Thanks for having me. Yeah, our favorite names at this point are Lennar and Taylor Morrison, and a little bit different reason for both. But what you're seeing is a scenario where demand is far outstripping supply. And what we like about Lennar's actually slowed their pace down a bit and said, you know what, let's make as much as we can on the individual home and not just blow through these valuable land positions we have. So we think it's actually, in a unique way, a defensive move as well. It allows them to manage the construction costs. Their contracts don't get too far ahead of their input costs. And so that'll help them maintain margins. And you layer on growth of communities on top of that, particularly at the entry level. And we think numbers need to go higher for Lennar next year. For Taylor Morrison, a little bit of a smaller builder, they've made a real pivot from the trade-up buyer to the entry-level buyer over the last couple of years. And that's where all the demand strength really lies on that entry-level segment. So we like those two names here, even with these stocks at 52-week highs.
Tendai, let's talk about the dynamics in the market right now where prices are already up. You could argue it is the flip side of lower rates, and you think rates could go half a point lower from here. I mean, tell me why a 2.3% 30-year mortgage shouldn't be out of the question.
Yeah, thanks for having me. If we go back to before COVID days, there's a spread between the 10-year Treasury and the mortgage rate, and that increased because of COVID from around 170 basis points to at its peak about 280 basis points. And we've seen that spread narrow because of the Fed action and because of other investor interest coming back into the mortgage market. If that spread narrows all the way back to where it was pre-COVID, that can take us to 2.3%.
Will it narrow all the way back, or is there a new normal here?
I think it can narrow all the way back because we've seen it narrowing over the past 6 months. It's narrowed about 50, 60 basis points, and it could continue to narrow as long as the Fed remains active in the marketplace. I think there's space for it to narrow, especially if we start to see lenders take a little less profit as volume slows down.
Yeah. Jack, what would happen if we saw a mortgage rate that was below 2.5%, that was headed towards 2% even? I mean, what would that do to home prices? Because while it may help the builders to some extent, it's obviously just a mathematical equation. It just means people are using that monthly budget to go a little bit further. And so the house that would have cost $350,000 2 or 3 years ago now might be $415,000, but nothing's changed, and everybody's kind of in the same boat here altogether. What would happen if prices continue to rise as quickly as they have over the past few months?
It's actually something we're keeping an eye on. I mean, my counterpart here is exactly right. Mortgage rates can come in narrower for structural reasons. We think they will. We think as lenders get more capacity online, they'll be able to handle this volume. And so we could see that natural widening narrow further. Look, if you've got a $3,000 a month housing budget, your affordability, you can afford $100,000 more home at $275 than you could at 4%. This is real buying power. And if you think about where we're at with demographics, a lot of first-time buyers coming into the market, they're probably paying that or something higher in rent. And so this really puts purchasing power in the average buyer's pocket today. Now, trees don't grow to the sky. Incomes aren't growing as fast as home prices. And so, you're right. It is a mathematical equation. Rates go down, prices go up, people can afford more. Some of that's going to get squeezed out. You do have to be careful. Remember, at the end of 2018, when rates spiked, new home sales really hit the brakes very quickly for 3 or 4 quarters because builders pushed price so much, and then we had that snapback. So, it is a risk, to the extent builders continue to push on the price side if rates were to move against them. But for now, they're easily able to, increase prices faster than input costs and labor costs are going up.
Shepard Smith here. Thanks for watching CNBC on YouTube.